Good morning, everybody. Another Daily Market Report brought to you by Mike Bjork. Today is Friday, and happy Friday to you guys. It's October 6th. We got the important economic news releases scheduled for today, and that is the non-farm payrolls brought to you by the Bureau of Labor Statistics here. So for the month of September, we had August, we had 169,000 new jobs created. Now, there were some revisions here, and I'll touch on that just after I go finish this up. But expectations for September is 75,000, and it came in a huge miss there. It actually went negative 33,000 jobs for the month of September. Now, we had some revisions. The 169,000 was increased by 13,000 from, there was revision of 13,000, so it went up to 169,000. But in July, which is not shown on here, it dropped. They minus 51,000, so that brought that total to 138,000 jobs for the month of July. So July actually had a bigger revision than what we had increase for August here. Now this number here is actually the lowest we've seen. This number, negative 33,000, is the lowest we've seen in 7 years. So this is quite some time since we've had this, a negative number showing. Now, we also got the unemployment rate for the month of September, and we had, it's been at 4.4%. We thought it would continue at 4.4%, and it dropped to 4.2%. So obviously a very good number there. That's the lowest we've seen in 16 years here. So we're seeing some great numbers here. Now, something that's not on this chart I'm going to touch on, that is the U6 number. A lot of people feel this is more accurate because it really takes into a whole count of everything. Really, it comes into it, and this is more of a true number in many people's opinions in terms of what where our economy is at and where our job numbers are at. So currently, it's at 8.3%. It dropped from 8.6 in August. So in August, it was at 8.6 and dropped down to 8.3%. Now this is a huge drop from last year, of September 6th of last year. Of 2016, it dropped from 9.3%. So we dropped a whole 1% point in 1 year here. So great job right there in terms of what we're getting for jobs growing in here. So let's move on to average hourly earnings for the month of September. We had a 0.2% increase in the month of August. Forecast for September is supposed to go up to 0.3%. It pretty much blew it out of the water at 0.5%. It grew up 0.5%, which kind of a lot of people expected. Remember, we've been talking about wage growth being kind of light here, and this is one of the reasons why inflation's been so stubbornly low, because wages aren't going up. So we got a nice little surprise that we saw a nice little pickup in the month of September. Now the clue, obviously the testament would be is if this continues, if we could see this continue to rise at a pretty good pace. So what that does, it brings us up from year over year, it brings us up 2.9% versus 2.7. So it was previously at 2.7, and with this 0.5% increase, it brought us up 2.9% year over year, which is obviously, again, good numbers right there. And last but not least, we got the wholesale inventories for the month of August, and we had a pretty good pickup in July at 0.6%, and in August, and then August you see it pick up at 0.9%. So good numbers, overall number, except for obviously the non-farm payrolls losing numbers. And of course, we could attribute that to the Irma and Harvey hurricanes here. So let's jump ahead here at the headline news. The stock market is down. A lot of people think they're kind of taking a break, but and they're kind of not sure, how the market's going to react to it to begin with, with the jobs number, because they were expected to be low, but obviously much lower than we really anticipated, especially when you figure 75,000, you're over 100,000 jobs differential right there. Later today, we do got some Fed speakers speaking again today. Yesterday, we had some Fed speakers talking, and again today we got that going on. And speaking of such, basically the Fed funds futures rate has increased to 91% for the December meeting at the FOMC meeting in December. So now basically there's a 91% chance that the Fed will go ahead and raise rates again in December. Speaking of some of the good news we've been seeing with ISM numbers coming in pretty hot this week, and then that wage increase. Wages going up a little bit, which helps out. So overall, that is still pretty good. It looks like it could be in line and more definite that this is going to happen in December here. So let's go ahead and take a look and see what's going on with the bond market here. And as the bond market is reacting negatively, of course. So we've started the day off lower. We were pushing this line of resistance, which just below that is a 200-day moving average here. We are off our lows so far this morning, which is obviously good signs. But right now we're still about 6 basis points from this point to this point. So there's not really any change in pricing. Yes, we did get a change in pricing. Alert to lock in, because it did close out the day at 19 basis points down 19 basis points. But today we're down about 6 basis points so far. So again, be cautious here. This could further slide, as we can see. Let's take a look here at the yields, and yields are again way up here. We're now testing this. As we mentioned, we had a lot of room, even yesterday I've talked about, or even this week, we got a lot of room up here, and that so it kind of concerned me that we could see further deteriorations on the mortgage-backed securities due to all that room here for yields to kind of spread. So we're up about 3 basis points currently, which brings us up to near 238 to 237, 238 range here on the yields. Again, that's where we're kind of sitting, why rates are going up a bit. So that pretty much wraps it up for the day. I hope you guys have a wonderful weekend here. Remember, next week we start the Great Unwind, as they're terming that. Now, if you remember the last FOMC meeting, the FOMC meeting basically said October 10th they're going to start their unwind, where they start unloading or lowering their assets with the mortgage-backed securities and treasuries. And a lot of people, because this is a first, we're not sure how the market is going to react to it. So be cautious next week. It could be a negative, it could be positive. We're not really sure exactly what to take from it, as again, they are going to decrease their holdings of the assets starting next week. So again, we're going into unknown territory here. And but meanwhile, I hope you guys enjoy your weekend, and we'll see you guys next week. But if you guys want to get updates, again, here's my Twitter page. Just go over to Twitter. I do post throughout the day. Enjoy the weekend. Bye-bye. Thanks.